Hello, everyone. Welcome back to part 3 of our discussion of Chapter 6 and business expenses. In this one, we're going to cover some of the rest of the business expenses that we didn't get to with depreciation and so in the earlier ones. So, common ones, and again, remember, this is not exhaustive. There's no way to list all of the expenses, but one of the key things, and one of the ones that comes up often with the business, is transportation and travel. And when we talk about transportation, we mean getting around in our area, and travel is about going overnight. All right, so that's how we differentiate. When the tax law is referring to one or the other, transportation is local, you might say, and travel is out of town. Okay, so again, the issue is it necessary? Is it ordinary? That sort of thing. So driving around in your local area, one workplace to another. Now, what is not, deductible is commuting to your place that you work. All right, but getting from, if you work at two different places or visit clients or customers or travel to a client workplace away from your regular workplace, and even from your home to a temporary workplace, then not where you usually go, but where the boss has told you you have to go for the next 6 weeks or something. Those are all transportation. We'll talk about home office a little bit later, but if you establish that you have a home office and you need a home office for your business, then traveling from your home, which is one of your office, to any other place you do business is transportation and is deductible. So it's very valuable, not just at the home office, but also to establish that you have more than one location for business, and that traveling from your home office to that other location to meet with someone or something like that is deductible. So you have two choices when it comes to auto expenses. You can use the actual expenses, business auto costs. You can keep track of repairs. You'll calculate depreciation. You'll keep track of insurance, gas, all that kind of stuff. All right, and then you have to keep all the receipts. You have all that stuff. Now you still have to keep track of where you go. Either way, okay, you have to have a record that your transportation was actually business related. But all you have to do if you use the standard mileage rate is show the distance, and then you just multiply by 56. That covers all the expenses, including depreciation, on the vehicle that you have. Okay, so that is often the simplest way. If it's a very expensive vehicle to operate, your cost may be more than 56 cents per mile. If it's cheaper, if it's a normal vehicle or even a very cost-effective vehicle, your costs are going to be much lower than 56 cents per mile. And so 56 cents per mile is going to be your better deal. So you can choose, but you can't just go flip back and forth between years on that. For traveling overnight, okay, we're talking about overnight stay. This is what we call about travel. You can deduct the travel to get there, right? The lodging while you're there, and meals while you're there if you're overnight. Contrast that to meals while you're at home. You're running into your various clients and you stop and get lunch. That is not a meal that's deductible because it is No, not out of your area. You could have brought it with you. If you did that same thing with someone else, a business client for a business meeting and had a meal, then you have a deductible meal. But just having a meal by yourself because you don't want to drive back to the house isn't a deductible meal. But when you're out of town and don't have that option of going home, then you have a meal, and then you have actually other incidentals, like if you had to get your stuff dry cleaned while you're there or something like that, that would be an incidental expense. As soon as you are going to be at a place out of town for more than a year, that now becomes your tax home, and now you're not traveling anymore. Now you've just moved to a no location. Okay, so if there's issues with if part of the trip is personal, so we talked about the fact that you can allocate between personal and business use, and that's fine, and that becomes particularly important when you're talking about travel, because often on a business trip you will do something personal. That's not going to disqualify the whole thing. The transportation is still deductible, the whole thing, as long as the primary reason you went was for business. But if you spend some personal time, you may have to allocate your meals, your lodging between the personal time and the business time. And then there's always that you shouldn't be lavish or extravagant. Now, there are what we call per diems for even travel and issues, which work the same way as the standard rate. You just have to prove that you went on the trip and it was for a business purpose, but you can count up the cost based on a set amount that the IRS publishes for lodging, meals, and incidentals, and you don't have to keep all your receipts. You just have to show that you traveled for business. So that's a per diem also that works and simplify your record keeping. So the thing about meals for 2020 and 2021, or 2021, 2022, business meals had been deductible for 50%. Now as long as they're provided by a restaurant, they're 100% to try to bolster restaurants, okay, during the pandemic. But it has to be related to business. So this is if it's local, okay? If you're out of town on a business trip, then that's assumed to be related to business, even if you eat by yourself. But if you are local, it's got to be with a client or some reason to discuss business, okay? Entertainment is no longer deductible, okay? So you can't take clients out to the ball game or to a show and count that as business entertainment. If you took your client to a meal and you discussed business, then the meal part is deductible, but not the entertainment part if that was after. Okay? And mentioning that per diem, $55 per day if you're traveling, okay? That's what you can deduct. And that can differ depending on where you're traveling to. But that's the overall rate, and then it's adjusted for high cost areas. All right. Other things that might come up, especially very valuable, is home office. You use a part of your house exclusively for business, regularly in your business. It can't be a hobby, it has to be a business, and technically it can only be used for that business. That's the only reason for that area. That's the only use of that area. So what that happens is you fill out Form 8829, and it doesn't have to be that you see clients there, although that's a very good indication you have a home office. If you have no other place and all you use your home office for is to send out bills or correspond or whatever, do Zoom calls in today's world, then it's still a home office. It's still fine. You don't actually have to have customers come to your home for it to qualify. So the way that we typically deal with the cost is you figure out your cost of your house, okay? And then you figure out percentage of the square footage that is for business. And then you multiply the total costs for your house by that square footage, that percentage. All right? If you have regular business expenses, like, copies or paper costs or things like that in your home office, they're deductible like they would be anywhere else. So the home office deduction is all about the costs that wouldn't normally be deductible, like the utilities on your house and like your maintenance on your house, home insurance, homeowners insurance on your house, even mortgage interest on your house. That's deductible as a business expense, not just an itemized deduction, if you can establish home office. All right, even depreciation on the house. So we learned about depreciation earlier. You treat it as a commercial property, 39 years. It's not fast depreciation. You can't use any of the bonus or any of those other special depreciation, but you can calculate depreciation, again, on just the part of your house that is used for business. Now, when you do the home office deduction on the Form 8829, you have to take the deductions in order. Okay? So first thing you deduct from your income from this business that you're operating out of your house is the direct expenses, the expenses that would be deductible regardless of where it was happening. Okay? So that's deducted first. If you still have income that you from that business after you covered those expenses, then you calculate your home office deduction except for depreciation. So all of the other ones, starting with taxes and interest, the things that would be deductible as itemized deductions anyway. All right, and you deduct those for your home office, okay, until you've deducted all of those. If you still have income, meaning the income is still higher than the deductions you've calculated so far, then you deduct depreciation. So depreciation is always last. And the reason why we're so picky about this is because the law says you cannot deduct more. If you use a home office deduction, you cannot have a loss on that business. Meaning you can't have more expenses because of a home office deduction or home office expenses than you have income for that business. So any leftover has to be carried forward. And so what you're usually carrying forward is the depreciation, right? Because that's the last thing you deduct. So that's the most likely thing you're going to carry forward. All right, just real quickly, business bad debts. This is situation where you sold to a client or customer on credit and you accounted for it as accrual. People, if you're using cash basis accounting for your taxes, there is no business bad debts. This only happens if you count sales as revenue when you make the sale and not when you collect the money. Most businesses just count it as income when they collect the money. So there is no business bad debt. So it doesn't come up that often. But if you count it as income when it was done and that person doesn't end up paying you, it can be deducted as bad debt expense. You have to be able to show that you did all that you could to try to collect the money. Okay? So that's a little bit of a high bar. Difficult to prove that. And business casualty loss is a business property that was destroyed by some kind of natural disaster. Okay? Doesn't have the same limit. Still, it would be a loss, but you still have to worry about if the insurance pays off on it. So it's not a loss if the insurance pays you for everything that you lost, even on a business casualty. Okay, but it doesn't have to be in a federally declared disaster area. It doesn't have the 10% AGI limitations that we talked about when we were dealing with personal casualties. This is a business. This has to be business property destroyed. Okay, we mentioned this right at the beginning. Hobbies. There's no such thing as hobby expenses anymore. No more hobby losses or anything or expenses. If it's a hobby and you sell something and make money, it's still income, but you don't get to take the expenses. All right. What if you get some education, okay, for your business? You go to some classes to try to get better at do that. As long as you are maintaining and improve your skills, that is a deductible expense on the Schedule C as a business expense. If, for instance, if I'm a CPA and I have to get continuing professional education each year, that's a deductible expense for my business. All right. However, they put a couple caveats in if it qualifies you for a new trader business. So if you want to become a different business, then that technically is not deductible. And it can't be to just meet the minimum requirements for employment. All right, so it's very hard sometimes to decide whether it meets the minimum education requirements for employment or it meets the express requirements of the law regulation for a job. So those are some hairs that don't split. It's usually not a big amount of educational expense, but be aware that there is a little bit of a tricky area in terms of deductions. All right, self-employment tax, important calculation. When you have a business operating, you're by yourself, all the income is subject to self-employment tax. So this is the same idea as your employer taking money out of your check for Social Security and Medicare. All right, so if you're an employee, your employer takes it out of your check and pays that for you. If you're the self-employed, you're both the employer and the employee. So you have to take care of it all yourself. So it's the Social Security part, 12.4%, Medicare, 2.9%. Total of those two together is 15.3%. When you have self-employment income, you pay on the Social Security part up to $142,800 in 2021. If you make more than that, then the part that you go over that, you don't have to pay the Social Security part, only the Medicare part. So the Medicare is not limited. You make, whatever you make is included, okay? And you have an additional Medicare if you're over $250,000. All right, so there's an add-on Medicare as well. But the Social Security stops when you have, or you only pay it on the first $142,800. All right, so the way you calculate self-employment tax, you take the income from your Schedule C, okay, your self-employment income, you multiply it by 0.9235, all right, then you apply this percentage depending on whether you've reached the limit or not. This is all done on Schedule SE, tax form, okay, and then you put it on the 1040 as other taxes. Right? After you calculate your tax liability on the 1040, there's a place for other taxes, including self-employment tax. Now, once you calculate that, then you also, as we talked about in chapter 4, there's a deduction for half of that for AGI on the 1040. Half of your self-employment tax is a deduction. And then the last deduction we want to talk about is QBI. All right, this is not for AGI, but it is on the 1040 directly. It doesn't have its own form. Well, it does have its own form, but the actual deduction is subtracted on the 1040. You calculate the deduction or potential deduction on 89.95, but the QBI deduction is really kind of hard to wrap your brain around, because it's a deduction based on your income. So you have to subtract all your other expenses, all your other deductions, and then do QBI. All right? So, and if your other deductions are more, meaning if your business is losing money, doesn't have other, then you don't get any QBI. So you have to have a profitable business. But if the business is making money, then it could be as much as 20% of the qualified business income. But it's the lesser of 20% of the business income or 20% of the taxable income. So if you have your taxable income is lower, okay, than your business income, then you could end up with a QBI that's lower than 20% of the business income. This applies to all businesses and is very broad. Basically, anything on Schedule C would be qualified. If it's a rental, we'll talk a little bit about that later. There's possibility that it's not qualified, but anything that would go on a Schedule C would be qualified for this. And you don't have to worry about it too much. You just figure it out. Now you have to wait till after you get all the other expenses until you get to this threshold, $329,800 married and $164,900, and then all types of restrictions come in. If your income is below that, this is a very broad deduction. As soon as your income gets higher, all kinds of other restrictions kick in, like, all right, certain businesses start to phase out. The QBI goes away if you have a certain type of business. Typically, anybody that does professionals, for instance, lawyers, doctors, accountants, would be, if your income is over that threshold, then your QBI starts to go away. It starts to phase out. It also can, and even on other businesses that still are not those type of businesses, you could be limited based on not having enough W-2 income, not W-2 wages paid to your employees, or not enough assets. So you can still, but those limitations don't kick in until you hit this threshold. But once you hit that threshold, you need to be aware of those restrictions based on W-2 wages, assets, or on the type of business that is involved. Under that threshold, basically any business qualifies.